Well, as we reported earlier, it's been another volatile day on Wall Street with the market plunging again.
U.S. indexes are down 10% or more since the beginning of the year, and that makes us 401k holders very nervous. Moses Altsech is a professor at the University of Wisconsin in the School of Business and the School of Human Ecology. Nice to see you, Moses. Thanks for coming back today.
Thank you for having me back.
So it's been another stomach-churning day today. The stock market is off to its worst year ever. The start of 2016.
Since the first of the year.
What is going on?
Well, you know, some of this we could have seen coming. In fact, the first indications already started happening right after Labor Day, right? That China had an economic slowdown. There were concerns about growth in China, and then the oil prices kept dropping and dropping and dropping. And of course, Iran coming into the fold and now producing oil, and OPEC being reluctant to cut production. All of those things contribute to, you know, a lot of worries. I mean, the all-time sort of low oil price, certainly all-time, you know, as far as you and I can remember for a long time, right? That's great news if you're driving to visit your aunt in Seattle, but for a lot of people, it's not great news any more than, you know, super high prices are. So people are worried.
How low can the stocks, can Wall Street go, do you think? Are we in a bear market now?
It seems that we are in a bear market. However, you have to consider that the stock market is just one economic indicator. There are a lot of other economic indicators that are not showing signs, you know, of crisis. The housing market is doing great. In fact, I think we still expect something like an 18% increase nationwide. The domestic auto sales are doing great. There are other things that are doing well, and I don't think really, you know, people or the prophets of doom are already talking about a recession. It's going to be a recession again. You know, never say never, right? However, right now, the indications are not that there's going to be a recession sometime soon. The indications are, you know, that growth is going to be a little slower than expected. Last year, economists were predicting, there's a survey of 90 economists on what their outlook is for the U.S. economy. Last year, they were predicting maybe 2.8 growth for 2016. Now it looks like it's going to be 2.5 growth. That's still growth. You know, that's still growth. You got it. And, you know, the concerns about China, the fact that it was growing 10% for so long, and now it's slowed down to 7%, and people are saying, well, maybe it's going to be 6.8. That's still very robust growth. I'm not saying that you know, people who are concerned are imagining things, but certainly this kind of drop in the stock market is a little bit of an overreaction.
So what is your best advice to people? To just ride this out, wait it out, not panic?
Yeah, certainly not panic. In fact, we've seen this before, right? During the Great Recession, that's very recent. The stock market was all the way up to 14,000 points, dropped all the way down to 9,000, and you know, some people cut their losses and left the market. And then what did it do? It went right back up to, you know, 16,000, 17. So you know, it's one of those things. In 1987, I remember that the stock market dropped 25% in one day. It was at 2,000. The Dow was at 2,000 and dropped 500 points in a single day. Black Monday. And you know, we still survived, and we're still here, and we saw it go from 2,000 to 4,000 to 6,000 to 8,000 and on and on and on. So this is a problem for people who perhaps needed their money. They're about to retire, you know, tomorrow, and you know, they're concerned about how much of their retirement savings are, you know, are going to be there. For somebody who's not about to retire, don't look at your 401k. You know,
don't
it's going to affect your heart rate. But you know, we're going to be okay if we have a little slower growth. So be it. I'm a little less worried than the average bear out there, and let's you know, let's not panic.
Don't open up the 401k.
You got it.
We've been through this before. Moses, thanks for being with us.
Always good to talk to you, Moses.
My pleasure.
Thanks
Thank
for
you for
coming
having
in.
me.